Hi, and welcome to this week's Property Insider Chat, where Dr. Andrew Wilson and I discuss what's happening in our housing markets. We talk about the latest My Housing Market rental report, and unfortunately, there's no good news in sight for tenants. We also discuss how the latest retail figures and building approval figures are going to affect the way the Reserve Bank is going to think about interest rates, and we dissect the latest auction results to give us a good in-time indication of what's happening in the housing markets. If you want to keep up to date with what's going on in our real estate markets, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. Despite all the challenges thrown at them, our housing markets have kept rising for 15 months in a row now. Not only the house prices, but also rents have risen strongly, and there seems to be no relief in sight for tenants. The chronic housing shortage is, of course, exacerbated by very low building activities, low building approval levels, and immigration, which still remains at very high levels. So in this week's Property Insider Chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, I'm going to ask for the details of their latest market rental report. And I'd also like to discuss some of the other data that's come out over the last little while, including retail figures, home building approvals, and weekend auction results to see how they're going to affect our housing markets. Hi, Andrew.
Yes, good day, Michael. And another month rolls past, and here we are with another rent report. And it's getting hard to change the narrative to some degree because it really is same old, month in, month out, which isn't really good news for tenants, as we know, and better news, of course, for landlords. Maybe some trends we could pick up from the latest report for March, but still, it's a very tough market for tenants.
We see in the news long queues of people waiting for open for inspections and reports of tent cities occurring. What's actually happening on the ground, Andrew?
Well, still a tough market over March, as I suggested, Michael. Vacancy rates remain tight and generally higher rents for both houses and units over March. And it certainly is a nightmare environment, really, for tenants seeking accommodation. As you've suggested, we do see those queues of people waiting for open inspections for available properties. And it must be really tough and challenging for those seeking accommodation. It's not just, okay, you've got to pay higher rent, but it's just the challenge of securing a property.
Disheartening, isn't it? It must be terrible.
Yeah, because you're in a long queue in competition. It's not really a transparent process. You don't know where you sit in the line in terms of your precedents, and you can miss out one after the other. And if you're struggling to find a roof over your head, of course, that's an essential service we require is accommodation. It can be really tough. But our latest report, as I said, doesn't really offer much hope for tenants. This is when we look at houses, we had every capital city with the exception of Canberra. The majority of capital cities for house rents were either flat or Canberra fell 1.3%. Again, we had some higher rents. Melbourne up 0.8% over the month. Brisbane up 1.6%, just keeping that energy going in Brisbane, which certainly is a tightening market, a tight market and tightening rental market, and Perth up 2.3%. The issues really are the vacancy rate, which sort of tell us the story about just what is available, Michael. And vacancy rates are under 1% in every capital city market, with the exception of Canberra, which is right on 1%. And vacancy rates really were mostly unchanged over the month, with Darwin falling and Brisbane just up slightly. But you can waver around when you're getting, 0.5, 0.7, 0.8% vacancy rates. You get those marginal easing in terms of month to month, but it really doesn't signify any significant change in the availability of rental stock. And housing is particularly in short supply, Michael, with, as I said, vacancy rates all under 1% except Canberra at 1%, and certainly no sense there that the position is improving. And, I think affordability is a problem, obviously, with rents, and we don't see the constant increase from month to month because tenants just can't afford to be continuing to pay 2 or 3% more per month. So they sort of wait until they can build up their capacity, and then the rents start to rise again, which is inevitable given high demand and shortage of properties. And we look over the year for good results for landlords there, with Perth the top performer over the past year for house rents, up 15.7%, Melbourne up 14.3%. Sydney up 12.2%, Brisbane up 10.5%. So the big capitals have all recorded strong growth in rents over the year, Michael. So really no change in houses there. Underlying position remains very, very tight, and it's inevitable that we'll continue to see rents rising, which is only restricted by the capacity of people to pay higher rents, which is about other costs with higher inflation and wages. But it has to be an upward trend because of the shortage of supply.
Well, there's about 3.5 million rental properties in Australia, and the vast majority of those, 90%, are being provided, more than 90%, by mum and dad investors, as we call them, normal Australians providing rental accommodation. I read recently, Andrew, that the average tenant moves every 3 years, meaning there's approximately 1 million rental transactions a year just from existing tenants. I guess at the moment, they're not going to want to move as easily. On the other hand, though, they've got to pay higher rents. And of course, there's adolescents leaving home, people starting. Then there's the divorces, domestic issues that create new tenants, and then all the overseas migrants. So there's people coming into the rental market continuously, but very little, well, actually hardly any new stock.
Yeah, that's right, Michael. We'll look at the latest building approval data shortly. But even though houses, as we just discussed, are really showing no sign of improvement from the tenant's perspective, maybe some better news for the unit market, the unit rental market. And this is just at the margin. We actually saw more rises in rents for units over the month compared to houses. Sydney was the top performer. Sydney unit rents up by 3.1%, Michael. Wavering a little bit, Sydney rents have been over the past 6 months for units, but back up now to that $750 a week mark, which is clearly the highest median asking rent of all the capital cities. Melbourne was up 1.3%, Brisbane up 1.2%. That Brisbane market continues to offer higher rents in their tenancy markets. Hobart up 1.1%, Perth East just 0.4%, and Darwin was flat. The yearly growth higher than houses. We've got Melbourne rents, unit rents, which are still quite affordable compared to particularly Sydney and Brisbane, up 17.5%. And there's really been a rebound in the Melbourne rental market over the last 6 months, particularly units. And of course, as you suggested, Michael, that represents I guess, the wave of migrants coming in, particularly student migrants coming into Melbourne. So I expect more upside there, but up by 17.5% over the past year. And Perth up 14.9%. And as I mentioned, Brisbane up 60.2%, Melbourne up 17.5%. I think the one interesting point that we could perhaps make for the unit market, Michael, is that the vacancy rates are just starting to tick a little bit higher in the unit rental market. Vacancy rates are now mostly above 1%. Now, 1% is still a low vacancy rate. Let's not get carried away here, but we're really looking for 2% to get a balanced market.
Yes.
But just some sign that the trends are now pushing upwards for vacancy rates. Still low, but nonetheless looking a bit brighter than the house market, which is just basically run out of stock. So yeah, trends were upwards for vacancy rates over the month. These things, as I mentioned, can waver.
Seasonal effect as well, Andrew, isn't there? Because often at the beginning of the year, people are moving to new jobs, new education, kids in school. And over the winter months, in general, there are fewer tenants looking to move. But still, as you say, there's just not enough accommodation for those who are looking to move.
Well, just trying to pick some trends here, Michael. And as you said, there are months, particularly beginning of the year, when you have the semester starting, the school semester starting, and that's when you tend to get more demand. But it's sort of working the other way around here. You've got higher vacancy rates through that period where you actually have higher demand and you'd expect lower vacancy rates. But I do think, look, there's just some signs which have been gathering that there's a slight improvement in the unit market for rentals. Vacancy rates are still very low, still a very tough market. Rents are still significantly higher than they were a year ago in most of the capitals. But maybe we can just offer a glimmer of hope there in that unit market early days. But as I said, the vacancy rates are still very, very low.
That's a shame. I guess it's a sign of what we've kept mentioning week after week, the fact that it's the progression of a whole lot of factors that started a number of years ago, way back 2016, 17, when the government started to make it harder for property investors. APRA made it harder to get loans, and there's fewer investors and little stock at the moment. And we'll talk about that in in a moment to what's happening with new building. In the meantime, there's also been news about retail sales. And why I'm interested in that is I'm really wanting to, like I guess everyone else who's in the property field, interested in what's going to happen to interest rates. And the government's juggling all these things. And it seems our economy is still behaving much more strongly than the Reserve Bank would like.
Absolutely, Michael. And really, given we've had all these interest rate increases, which began nearly 2 years ago, it's really had no impact on the economy. You really can't put together a case to say that interest rates have dampened economic activity. Unemployment rate has still got a 3 in front of it. Retail sales are still higher than where they were a year ago. And of course, over the past year, 18 months, our retail sales data was inflated by all those COVID stimulus packages. And we continue to track at those levels, Michael. Yes, we've had more immigration, which means more people spending. So that sort of elevates it. And of course, because we measure the value of retail sales with inflation, that means that also inflates it. But nonetheless, we're still tracking 40% higher than where we were before COVID. So it shows there's still a lot of heat in that retail market. A lot of excuses for what's happening from month to month, but those that are trying to justify the impact of higher interest rates. And I thought it was interesting that retail sales were higher by just 0.3% over February, Michael, but they're still up 1.6% over the year. And we had followed a 1.1% rise over January, which was expected because we had the easing over December, which was expected because we had the boom over November, Black Friday, etc. Anyway, the ABS has been saying it reckons it's the Taylor Swift concert impact.
I didn't go.
It's quite interesting what the ABS comes up with from month to month to justify their position. They seem to be a little bit bearish on the nature of retail sales, but they have struggled justifying the fact that retail sales keep rising, Michael. So yes, it was all about Taylor Swift apparently that kept us going. So we'll wait for the next lot of data, but as I said, we're still tracking ahead of where we were a year ago, and we're significantly ahead of the pre-COVID position on retail sales, and even accounting for migration, accounting for higher inflation. It still shows that Australians are out there taking advantage of record wages growth and full employment.
Well, one of the other sets of data we look at is the home building approvals. That doesn't necessarily mean the homes are going to be completed, but it gives us an indication of what could be in the pipeline. So what did the latest figures show?
Well, not good news again, Michael. We had a surge over January. Well, we had a surge in units, and we had houses falling over January, which was a concern to see houses falling because they're a much less volatile data set compared to units, which we can go from month to month with volatile results from units. Again, that was the reason we saw building approvals fall by 3.5%. Of course, these are private sector building approvals, Michael, down by 3.5%, seasonally adjusted, which followed that 0.3% January rise. And the decline was about units, as the increase was about units the previous month. The decline this month was about units falling 24.9%. But houses rebounded, which was positive to see, up 10.7% following that 10% fall over January. New South Wales, however, was up by 23.4%. That was courtesy of a big development that was approved that came through Sydney, Michael, a big unit development. Has pushed up that New South Wales total to be the leading performer of the major states. But still, our growth levels remain chronically depressed. And the quarterly trend, after looking like it was bottoming out, Michael, as we've discussed, is now falling again. So that the quarterly trend is now starting to wane, and it's the levels of activity for national home building is well below where it was a year ago. So not a lot of good news there. And we can see when we compare the position today with over the year ending February compared to the previous year, we're well behind previous levels. And when we go back even further in time and we look at the capital city annual dwelling approval data, and this is what you alluded to, Michael, how things have changed nearly the past decade, which is having significant impacts on our housing markets. But we're down on trend 38% since that 2016 peak. So that's certainly a big fall in the number of building approvals for homes. And when we look at units, they're down 55.2% since that 2016 boom, Michael. Just as an example, the trend figure at its peak, this is the annual trend of monthly building approvals for units, was at 110,000 at the beginning of 2016, and now it's down to 49,000. So that's a big decline in underlying trend approvals for units.
And of course, we
Early
keep
days,
saying each time, Andrew, that just because they're approved doesn't mean
That's right.
those projects are financially viable to get out of the ground, does it?
No, that's right, Michael. Next week, we'll look at the latest house building index, which has been concerning over the last couple of months because it's actually reversed its recent trend. So we'll be hoping that latest data will show us recommencement of the improvement trend for house building costs, because as you said, that's a big barrier. You get your approval, but if house building costs are elevated, it means you've got to think very carefully about going ahead with the job, because there might be those issues to do with profitability because of high house building costs. So that means that there's likely to be fewer commencements per approval than with higher house building costs. So, but when we look at the data so far this year for the capital cities, again, Melbourne clearly ahead in terms of its approvals so far this year compared to the other capitals. 5,740 homes have been approved in Melbourne so far this year. Sydney, next highest, 3,907. A lot of that was from that, as I mentioned, that very big unit development that came through in Sydney over the month. That's lifted Sydney up. I think one of the points we can make is perhaps one of the reasons that Melbourne has probably a more balanced in terms of rentals and prices housing market is because it has a better supply line and it consistently outbuilds. It provides almost 40% typically of all the capital city building approval. So it has a better supply demand balance, but there are other significant issues in the Melbourne market that's holding it back. So we can't just say that it because it's got better supply line, that it's providing better options. I think Melbourne has an underperforming economy and still lacks a little bit of confidence going forward. And we've discussed the fact that we think Melbourne's got some potential for growth going forward once it starts to regain a bit of confidence.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, each week we also discuss the auction results. The things we've discussed at the moment have more to do with what's going to happen down the track with interest rates and availability and supply. But auction results give us an indication of how people are feeling on the day, on the ground, in the moment. And we had a break last week over Easter, so people got back into the swing of things this weekend. How did the auctions go over the weekend, Andrew?
Well, as you mentioned, Michael, auction results are a very good forward indicator of what's happening generally in the housing market. When we track clearance rates against prices, we can see that a very strong relationship, higher clearance rates, higher prices in Sydney and both Melbourne. And with our latest data, we've got the quarterly data for prices and clearance rates, and we can see that bounce back. We mentioned in the house price report last week that we've had a strong start to the year in terms of prices growth in most of the capital city markets. A bit of a surprise, the rebound really, because prices were just starting to ease after a strong year last year towards the end of the year, but they've bounced back this year. And we can see clearance rates are also higher so far this year, Michael. And we know that listings are high, in fact, historically high for this time of the year. And we're seeing record numbers of sales, of auction sales over the first 3 months of this year. So it's a very heady market in most of our auction markets. But as you said, Michael, we had a break last week, the Easter holiday hiatus, I guess we could call it. And that lingers on to some degree because we had school holidays starting in Melbourne and Brisbane after Easter. They've started now. And we'll have Canberra, New South Wales and Adelaide starting this week. So it's more distractions, school holiday distractions. April is the holiday month, as we know, Michael. We've got Anzac Day coming up as well. So we tend to have less engagement in the market because of that. So it's interesting. We had some on holidays, some not on holidays at the weekend. But when we look at the results, given the scenario of those distractions, I think the results were still quite positive. We had a big weekend in Sydney again, nearly 1,000 auctions, 908 auctions in Sydney, 72% clearance rate, which is a little lower than where it was prior to Easter, but nonetheless, still a good result there for most sellers, above 70%. And as I said, given that this is a holiday market moving forward in Sydney, you do have fewer higher priced properties because a lot do take the holiday period from Easter into the school holiday period. So I think that was a good result. Melbourne is in school holiday mode, 707 auctions in Melbourne. Again, a good number for the holiday season. And their clearance rate was quite steady compared to where it's been in recent weeks, 4 weeks, so 65.9%. Brisbane holiday mode, 86 auctions, good number of auctions there in Brisbane. Similar clearance rate to recently, 57.8%. Adelaide, 95 auctions, a full weekend there. The clearance rates have just started to ease a little bit in Adelaide from those stratospheric 80, 90% rates we were getting last year, but still good result for most sellers there, 73.5%. And Canberra, just down a little bit on the improvement that we've seen in Canberra over recent weeks, just back down into the 50s, 54.2% from 67 auctions. But, as we've mentioned, it's been a good start to the year. But as we discussed, those results are available every Saturday night. The capital city results snapshot is available on my LinkedIn account, Doc Andrew Wilson, and that's at 6:30 on a Saturday. And Michael reports the full national report, which includes the top sales for all the capitals and also the regional breakdowns in Melbourne and Sydney. And that's also out on my LinkedIn on Sundays as well. So I think some very solid results there, Michael, given we are in holiday mode, given Easter has been a little earlier this year as well. So onwards and upwards, and school holidays will start this week in New South Wales, South Australia and Canberra. So, we need to work our way, as we say every year, through to May before everything settles down and we know exactly how our market is once we've adjusted for all the differences in holiday times, etc. But nonetheless, it's undoubted we've had a very good start to the year this year.
Clearly we have, and some of the predictions people made at the beginning of the year are proving wrong. On the other hand, you and I were very confident about the market. It's very different from sitting on your ivory towers and looking at spreadsheets. We've got to understand what's happening on the ground and speak to the people who are there. Gives you an indication of the depth of feeling of both buyers and sellers. And it has been more confident this year, hasn't it?
Yes, it has. I think one of the interesting points, Michael, I was reading again yesterday, about a number of the bigger cities in the US are really struggling to supply their markets. This undersupply that we have, this lack of dwellings, is an international issue in the US, in Europe, in the UK. They're all struggling to find accommodation, and rents are rising and prices are rising. And that's in an environment of higher interest rates, but particularly the rental markets are very, very tight in most advanced economies. And again, it really, in my opinion, reflects a large degree the sort of philosophical view of policymakers that they've had over the past decade. The green tape, the red tape, all the tape that's constricted development, that's looked to favour public housing over the private sector. It's now coming up and really biting policymakers where it hurts. And no surprise, we're seeing some significant political ramifications from that as well, because people just aren't going to tolerate not being able to be housed. And as you mentioned, they're not going to tolerate, obviously, living in a cardboard box or a tent, but also seeing that in their neighbourhood.
That's not what Australia's about. And with an election coming up in 12 months' time, we've got some interesting times ahead.
Yeah, absolutely. So let's hope the policymakers and the mandarins who have made these sort of philosophical views and have created these terrible environments maybe have a little bit of a revival on the road to Damascus or something, and some more market orientated policies, because we're going to need them.
Oh, we are. It'll be interesting to see how it comes around, but the cycle will move on. Thanks for your time, Andrew. Look forward to catching up with you again next week.
Thanks, Michael.